Everyone says you need $1 million to retire. I did it with half that amount, and today I'm going to show you how I'm making it happen and why I'm considering a bold move that could reshape my entire strategy. I've crunched the numbers, and what I discovered might change everything. After watching my portfolio grow almost 30% last year, should I move 150,000 out of the market? The numbers make sense, but timing feels tricky. I'm going to walk you through my entire thought process about this and share my latest portfolio numbers, including a YouTube update that just might surprise you. Sure surprised me. Let's dive right into my January update, because these numbers are at the core of the decision I'm facing. Currently, my portfolio is sitting at just over $473,000 after some strategic moves last summer, like relocating to another state and some home improvements I made designed to slash my long-term expenses. And even taking out my regular living expenses, my portfolio barely dipped, just 0.05% this month. I'll take that as a win. But here's what's exciting. This small retirement nest egg grew almost 30% last year. Here's the details. My savings at $11,150 is down $1,200. After-tax brokerage is at $20,302, no change there. My Roth is at $12,170, which is down $53. HSA at $5,051, up $132. My pre-tax IRA at $430,234, up $4,700. Here's how I've structured my retirement accounts to handle both growth and market volatility. Bucket 1 is at $60,500. It's enough to cover a year of expenses and any unexpected emergencies. Bucket 2 is at $264,500 in highly liquid CDs and dividend funds. Bucket 3 sits at $148,000, and that's in growth funds targeting long-term appreciation. Now, normally I'd have less in bucket 2 and a lot more in that growth bucket, but I've got my eye on a potential game-changing move that could really change my entire retirement plan, and I need that cash, but we'll get into that in a second. I recently made some strategic moves selling off my REITs to spread across my S&P 500 index funds, tech ETFs, and dividend funds. This mix isn't just chasing growth, it's about building a portfolio that can handle market swings without sending me into a panic. While my S&P 500 and dividend positions fight inflation through growth and income, I've got nearly 3 years of expenses in cash and CDs. That means I never need to sell when markets are down, and it helps me sleep at night. Everyone has their own risk tolerance levels, and this is mine. Your allocations should be set at what you are comfortable with. Now here's where things get really interesting. After watching my portfolio crush it last year, I'm considering a bold move that could reshape my whole portfolio. The opportunity? Selling my current home and using the equity plus about $150K from my savings to downsize and eliminate my $1,500 a month mortgage. But after the last few years watching my portfolio do so well, I'm having a really hard time wrapping my head around pulling that much out, even for a smart financial move. And here's a reality we don't talk about enough. Sometimes the smartest financial moves feel like the scariest ones, especially when you're riding a strong market. Maybe you can relate, feeling that pull between continued momentum and security. Those amazing market gains make me want to let it ride. But reducing fixed expenses and owning my home outright, well, that can provide a strong sense of security and stability, making my retirement even more bulletproof. The real question isn't about downsizing, it's about whether maximizing liquid assets beats maintaining paper wealth. Now, I ran all the numbers through my Bolden retirement planning software, which I'll review in another video, and I'll drop a link to the software in the description below. The numbers are fascinating. Keeping my current home means $320,000 in future mortgage payments coming from my retirement savings. Downsizing this year drops that to just $7,500. That's $312,500 I could redirect into investments. You know what's wild though? My overall net worth looks better on paper if I keep the bigger house. But having an extra $312,000 to actually use, that's real freedom. So I'm curious, how do you balance the emotional pull of a strong market against the security of lower fixed expenses? Let me know in the comments. When you're working with a smaller nest egg, every monthly expense really matters. And while I haven't made my final decision yet, seeing that $312,000 difference in debt payments really puts things in perspective. So for right now, I'm still keeping that big cash position ready just in case I find the perfect smaller home. There's not a lot available in my market, so I need to be able to move quickly. If I take Social Security at 62, it would add approximately $2,400 a month to my income. But thanks to my current setup, I have the flexibility to potentially delay and maximize those benefits. This isn't about waiting until 65 or having some arbitrary amount saved. It's about creating a life that works on my terms right now. And being flexible is important. Here's something I didn't see coming. This channel brought in $2,300 in January. I am super grateful and so excited to see what's still to come for the channel. This wasn't even part of my original retirement calculations, but it shows something powerful about modern retirement. There are always opportunities to build additional safety nets when you start thinking differently. It's not about hitting some magic number. It's about being smart with what you have right now. Want to see exactly how I'm spending my money in retirement? Check out my next video where I break down every dollar.